Today, watch out New Zealand, here comes 4%. Hello again, it's Martin North from Digital Finance Analytics, one of those posts covering finance and property news with a distinctively Australian and New Zealand perspective. Well, of course, economists are fickle at the best of times, but now Westpac economists responded to the latest labour market figures that I reported on yesterday, and also the strong wages increased, by raising their forecast peak for the official cash rate from 3.5% to 4%. And Westpac economists, like economists at the ANZ, expect that a 4% peak will be achieved by the Reserve Bank of New Zealand, hiking by 50 basis points at each of the next review meetings this year. That's next month, October and November. The OCR, of course, is currently now at 2.5%. Now, if that happens, it would mean 6 consecutive hikes of 50 basis points by the central bank, and a total of 325 basis points, or 3.25% this calendar year, which will easily be a record for the OCR in a calendar year. In fact, we've already seen a record rise so far this year, as the previous biggest rate hike in a year was just 150 basis points way back in the year 2000. And it's also worth remembering the OCR was first introduced in 1999. In its May monetary policy statement, the Reserve Bank forecast the OCR would peak at just under 4% by the middle of next year, and at the time most economists would have been thinking that the central bank would not need to go as high as that, but actually their views have been gradually shifting. And the first of the major bank economists to forecast 4% by the end of this year was ANZ. ASB economists forecast a peak of 3.75%. Bank of New Zealand economists see 3.5 to 3.75%, and Kiwi Bank thinks 3.5%. Current pricing in the wholesale interest rate markets is pointing towards a peak OCR about 3.8% by early next year. Westpac acting chief economist Michael Gordon said the June quarter data show that the New Zealand labour market remains extremely tight. Setting aside a slightly higher than expected unemployment rate of 3.3%, the details point to an economy that's running up against capacity constraints, and the upward pressure on wages is intensifying, he said. We now expect the official cash rate to reach a peak of 4% for this cycle. That can be achieved through 50 basis point hikes at each of the 3 remaining review dates this year. There is a risk that the tightening stretches out into the early part of next year, although we think that by then there will be a substantial body of evidence that the domestic and global economies are slowing. Kiwi Bank economists, Chief Economist Jared Kerr, Senior Economist Jeremy Krachman, and economist Mary Jo Varega, in their review of the labour market figures, reiterated that they expect the Reserve Bank to deliver another 100 basis points of tightening to 3.5% in this cycle. The risk is clearly high, however, they say. We're going to review our forecast following the Reserve Bank of New Zealand's August monetary policy statement. The Reserve Bank may choose to ignore the crisis in confidence, with both business and consumer confidence at recessionary levels, and plough ahead with rate hikes to 4% or above. The Reserve Bank of New Zealand is resolute in the need to tame the great inflation beast, and the only way they know how to do it is to, well, lift interest rates some more. They said, we remain wary of the risks of over-tightening. And the Reserve Bank of New Zealand has had great traction in the rate rises thus far, with mortgage rates more than doubling from the lows of last year. We expect the rampant rise in interest expense to have a significant impact on household consumption. Indeed, we are already seeing some signs of belt tightening in our spending tracker. So there you have it, 4%. And now more and more economists are piling onto that in New Zealand. And if we assume that New Zealand is ahead of the curve relative to Australia, what does that tell us about rates going higher here? Maybe some of the recent gossip here in Australia that rates probably won't rise very much further from where they are is more hopium. We'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.